Hey everyone, it's Collins. You see that make money online ad? Yeah, me too. We all want to grow our money, but let's be real. Most of those get rich quick schemes are just that, schemes. The truth is, building wealth takes time and it should start with a solid foundation. Want to grow your money with almost no stress? Bonds and high-yield savings accounts might be your smartest first step into investing. These options offer slow, steady growth, perfect if you're risk-averse or just starting. In this video, we're diving deep into these low-risk investments. We'll cover what they are, how they work, the pros and cons, and most importantly, how you can get started today. So whether you've got 100 or 10,000 pounds to invest, stick around to discover how to make your money work for you. Now, before we jump into the specifics, let's visualize your investment journey. Imagine two paths. One is labeled stocks, high risk, high reward, and the other is bonds and savings, low risk, steady growth. Most beginners get lured into the excitement of stocks thinking they'll get rich quickly, and while stocks can offer high returns, they also come with a significant amount of risk, especially in the short term. That's where bonds and high yield savings come in. They represent the safer, more stable path. While you won't see those massive overnight gains, you'll sleep soundly knowing your money is growing consistently and safely. In this video, we'll explore 5 smart methods for investing in bonds and high-yield savings accounts. We'll break down each option, discuss the potential returns, and even look at some real-world examples. By the end, you'll have a clear understanding of how to choose the right investments for your goals and start building that solid financial foundation. Let's start by unraveling this thing called a bond. In simple terms, a bond is like giving a loan to a company or the government. You lend them your money and in return, they promise to pay you back with interest. Think of it this way, you're essentially becoming the bank. Instead of keeping your money in a savings account, you're lending it out and earning a fixed interest rate. There are different types of bonds, each with its own level of risk and potential return. We'll dive into the specifics of each type later, but for now, just remember that bonds are like IOUs that pay you interest. A pretty sweet deal, right? Now, let's talk about high-yield savings accounts. These are like the cooler, more profitable, older sibling of your regular savings account. Imagine this. You're currently earning a measly 0.5% interest at your traditional bank. With a high-yield savings account, you could be earning 4% or more on that same money. That's a huge difference, especially over time. The best part, high-yield savings accounts are incredibly easy to open and manage. You can usually do it all online in a matter of minutes. And unlike some investments, your money is readily available whenever you need it. So you get the best of both worlds, higher returns and easy access to your funds. Chapter 4: Treasury Bonds, Lending to the Government. Alright, let's dive into the first type of bond on our list, treasury bonds, also known as government bonds. These are considered one of the safest investments in the world. Why so safe? Well, when you buy a treasury bond, you're essentially lending money to the UK or US government. And let's be real, they're probably good for it, right? Now, because of this low risk, the returns on treasury bonds are generally lower than other types of bonds. However, they still offer a decent return compared to traditional savings accounts, and they're an excellent option for preserving capital and generating a steady stream of income. If you're looking for an investment that's as close to risk-free as it gets, treasury bonds are a great place to start. Learning curve, easy, passive income, medium risk, very low, result 3 to 5% annually. Chapter 5: Corporate bonds, investing in big companies. Next up, we have corporate bonds. Instead of lending money to the government with corporate bonds, you're lending money directly to companies. Think of it this way: Apple needs money to build a new iPhone factory. Instead of going to a bank, they can issue corporate bonds to investors like you and me. Now, because companies aren't quite as reliable as governments, Apple, corporate bonds typically offer higher interest rates to compensate for the added risk. The level of risk associated with a corporate bond depends on the creditworthiness of the company issuing it. So before you invest, it's essential to do your research and understand the financial health of the company. Learning curve: medium, passive income, medium to high, risk medium based on company rating, result 4 to 7%. Chapter 6: Bond ETFs. Your diversified bond portfolio in one click. Now, let's say you want to invest in bonds but don't want to pick and choose individual companies or government bonds. That's where bond ETFs come in. ETF stands for Exchange Traded Fund, and it's essentially a basket of bonds all bundled into one convenient investment. Think of it like a diversified bond mutual fund that you can buy and sell on the stock market. Bond ETFs offer several advantages. First, they provide instant diversification. Instead of putting all your eggs in one basket, you're spreading your risk across hundreds or even thousands of bonds. Second, they're incredibly easy to buy and sell, just like stocks. And finally, bond ETFs typically have lower fees compared to traditional bond mutual funds. So if you're looking for a simple and effective way to invest in bonds, bond ETFs are definitely worth considering. Learning curve: medium, passive income: medium, risk low to medium, result 3 to 6%. Chapter 7: High yield savings accounts, your secret weapon for easy returns. Now let's circle back to high yield savings accounts. These are perfect for beginners or anyone looking for a low risk, high liquidity option. Remember, high yield savings accounts offer significantly higher interest rates compared to traditional savings accounts. And the best part, they are incredibly easy to open and manage. You can usually find the best rates online at banks like Marcos by Goldman Sachs, Alibank, or Discover. These online banks often have lower overhead costs than traditional brick and mortar banks, which allows them to offer higher interest rates to their customers. So if you're not quite ready to dive into the world of bonds, opening a high-yield savings account is a fantastic way to start earning more on your money today. Learning curve, very easy. Passive income, low to medium. Risk, very low. Result, 4 to 5%. Chapter 8. I-bonds, inflation-proof your savings, US only. Now for our American viewers, I want to introduce you to a unique type of bond called I-bonds, or inflation-protected bonds. These are specifically designed to protect your savings from inflation. Here's how they work. The interest rate on an I-bond is tied to inflation. So, as inflation rises, so does the interest rate on your I-bond. And if inflation falls, the interest rate adjusts accordingly. This makes I-bonds an excellent option for preserving your purchasing power over the long term. However, it's important to note that there are some restrictions on when you can withdraw your money from an I-bond. So, be sure to read the fine print before investing. Learning curve, medium passive income, medium risk, very low. Result, inflation adjusted return. Chapter 9. Top 5 platforms to jumpstart your bond and high yield journey. So you're ready to start investing in bonds and high yield savings accounts, but where do you even begin? Don't worry, I've got you covered. Here are 5 beginner friendly and trusted platforms to get you started. First up, we have Vanguard Total Bond Market ETF, also known as BND. This ETF gives you broad exposure to the entire US bond market, making it an excellent option for diversification. Next, we have iShares iBox, the investment grade corporate bond ETF, or LQD. This ETF focuses specifically on investment grade corporate bonds, which offer a good balance between risk and return. For high yield savings accounts, I recommend checking out Marcos by Goldman Sachs. They consistently offer some of the highest interest rates in the market. If you're looking for a safe and liquid option, Fidelity Treasury Money Market Fund, or FZFXX, is a solid choice. And finally, for easy access and no fees, you can't go wrong with the high yield savings account from Chase, Ali, or Discover. Chapter 10. Beginner's Playbook, Do's and Don'ts of Bond and High Yield Investing. Now, before you go all in on bonds and high yield savings, here are a few beginner-friendly tips to keep in mind. First, start small. You don't need a ton of money to get started. Even investing 50 or 100 pounds per month can add up over time. Second, reinvest your interest. When you reinvest your interest earnings, you're essentially earning interest on your interest, which can significantly accelerate your returns over the long run. Third, take advantage of tax advantage accounts like ISAs or Roth IRAs. These accounts allow your investments to grow tax-free, which can save you a significant amount of money in taxes over time. Fourth, avoid junk bonds. Junk bonds are bonds that are issued by companies with poor credit ratings While they offer higher potential returns, they also come with a much higher risk of default. And finally, be patient. Remember, bonds and high-yield savings are long-term investments. Don't expect to get rich quick. The key is to stay consistent and let your money grow steadily over time. Chapter 11. Navigating risk, understanding the trade-offs. Now, it's important to remember that all investments come with some level of risk. However, bonds and high-yield savings are generally considered to be much lower risk than stocks. Let's break down the risk levels of each option we discussed. Treasury bonds, as we discussed, are considered to be the safest type of bond because they are backed by the full faith and credit of the UK or US government. Corporate bonds carry a bit more risk because the creditworthiness of the company issuing the bond can fluctuate. Bond ETFs offer a good balance between risk and return because they diversify your investments across many different bonds. And finally, high-yield savings accounts are considered to be very low risk because your deposits are FDIC insured up to £250,000 per depositor per insured bank. So while there's always some level of risk involved in any investment, bonds and high-yield savings offer a relatively safe and stable way to grow your money over time. Chapter 12. Painting the picture, realistic results from bonds and high yield. Now, I know what you're thinking. All this talk about bonds and high yield savings is great, but what kind of returns can I realistically expect? Well, the truth is it depends on several factors, including interest rates, inflation, and the specific investments you choose. However, as a general rule of thumb, you can expect to earn anywhere from 3 to 6% per year on average with a diversified portfolio of bonds and high-yield savings accounts. Now, I know that might not sound like a lot, especially compared to the potential returns of the stock market. But remember, bonds and high-yield savings are all about slow, steady growth. They're not going to make you rich quick, but they will help you build a solid financial foundation, generate passive income, and achieve your long-term financial goals. So, there you have it. You're now equipped with the knowledge to start investing in bonds and high-yield savings accounts. Remember, these are fantastic options for beginners or anyone looking to grow their money with minimal risk. The key is to start small, stay consistent, and reinvest your earnings. And most importantly, be patient. Building wealth takes time, but with the right approach, you can achieve your financial goals and secure your financial future. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and share with someone just getting started. Drop a comment if you'd like a deeper video on any of these methods.